Hi, Jeremy Surrier here from MANSARD, bringing you the Boston commercial real estate sales trends to watch for the second quarter of 2020. So the question is, how's the market? And so what we've done is we've dug into the data, and we're going to bring you some new information on what's happening in Rockingham, Essex, and Middlesex counties. So the market's primarily north and west of Boston, and we're tracking the office, retail, and industrial markets valued between $1 and $20 million. So basically what we're seeing is a continuation of the trend of essentially around 2017, where we had a significant amount of building trades. And what we've seen in 2020 so far year to date has pretty much been on par with 2017. And when we annualize that number, you can see here that we're on track to end the year somewhere just shy of 2017, a little higher than 2016. This is assuming that we don't see a slowdown in volume over the next 6 months. But what's really happening in the market is interesting. You know, we've seen a slowdown in the effective year-over-year volume. And we saw this start in 2019, coming into 2020. And when we entered the year, that curve you see just below the zero line where it says 2020 annualized, that was actually dropping off more than it has. And the reason why we've seen a flattening in the effective change is that we are seeing consistent sales volume in the market. But what we are noticing is fragmentation in the market. And what we mean by that is that the office, retail, and industrial markets had been generally trending together in the market cycle, but we're now seeing that they're separating from each other. They're actually bifurcating. They're heading in different directions. We're also seeing that lending is becoming fragmented, where some banks are freezing lending on commercial property, others are aggressively lending with very narrow spreads. The 10-year treasury today is around 0.63. So the cost of funds is low, and banks have the opportunity to move money into the market and take market share and grow their books. But other banks are looking at the market with uncertainty. They're continuing to lend, but what they're doing is they're marking up their rates in order to offset risk. So let's take a look at what's happening by asset type. We have flex, retail, industrial, and office showing here. And at the top of the screen, you'll see the orange line representing a retail property has already started to show softening in the average price per square foot in 2020. We saw this emerge early in the year, pre-COVID. This was already starting to happen, but we expect this to accelerate as we go through the rest of the year. The office market saw a sharp uptick in 2020. And what we saw there was a significant amount of deal volume that happened in the first quarter. The industrial market continuing its upward trend, currently trading 50% over the long-term average going back to 2006, and the flex market showing some signs of weakness. So you can see here the orange dots represent markets that seem to be softening in the three counties, whereas the light blue dots show markets that are increasing in average price per square foot value. So let's dig into retail. So looking at the retail market, you can see here the average price per square foot is starting to soften in the three counties. But what's more interesting is to see what the impact of the pandemic is and what it's foreseen to be. We're not really sure yet how bad it's going to hit retail, but so what I did was I took the first quarter 2020 market cycle analysis published by Dr. Glenn Mueller, showing here that the Boston retail market was at peak in the first quarter of this year, okay, of the market cycle. And what I did was I took his forecast for the first quarter of 2021 and looked at retail, and you can see the drastic shift in the retail market into hypersupply heading into recession. In fact, he's moved every MSA in the United States for retail property into hypersupply and recession. So a very fast move for retail. This correlates to the average price per square foot pricing that we're seeing, some softening occurring in the greater Boston market. How about industrial? So industrial has been continuously appreciating. You can see here it almost looks like a hockey stick going from 2016 into 2020. We're exceeding average price per square foot pricing of $120 a square foot in the market. Now, looking at the same market cycle data from the first quarter of 2020 going to the first quarter forecast of 2021, check this out. Industrial was put at the peak of the cycle in the first quarter of 2020. The first quarter of 2021, expecting to stay the same. So Boston industrial, I would anticipate we're going to see increasing demand this year for this product and ongoing appreciation for this product type. So if you're an industrial owner, you're in good shape. Now, office has been a big question mark in the market as we've seen tenants keeping people at home. Debates are going on about whether office is going to recover. What's it going to be like to go back to work? Well, the urban market and the suburban market, which one's going to win out? We don't know. But what we have seen in 2020 has been an uptick in transaction volume for office. And what you're seeing here with average price per square foot pricing clearing the $160 a square foot mark in the suburbs, this is driven predominantly by first quarter 2020 trades. So what's the market cycle look like? Well, if you look at the chart here, the first quarter of 2020 put Boston office at the probably 2/3 of the way up the expansion phase of the cycle. So it was coming up. There's still some room for growth in the market in the first quarter of 2020. The forecast for the first quarter of 2021 shows Boston moving up and over the peak of the market into hypersupply. So the estimate here is that we may end up seeing a decline in demand for office and an increase in vacancy in the market with some rent concessions beginning to build. This certainly seems to correlate to what the news is showing about the subleasing market picking up as more companies are putting space in the market. But we haven't seen the full impact of the employee to square foot demand ratio yet in the market. This may end up shifting density in office space, and companies may end up recalibrating their footprints completely. So stay tuned to office. I don't think this story is over yet. We're still seeing it unfold. So what's the buyer activity in the market like? I pulled this chart out of Real Capital Analytics. They put this out on June 5th or 6th, and basically what they said here was if you track buyers in the market, there was about a 71 to 77% pullback in the market when the pandemic hit. That correlated to what CoStar was publishing, where about 75 to 80% of the deals that were under contract in April of 2020 were canceled by the buyers. When you overlay this with the 2008 correction, you'll see here the Lehman Brothers bankruptcy plotted. About 51% of the buyers left the market. So we saw a much sharper pullback in the market at the end of the first quarter of 2020 coming into the second quarter. But we are starting to see this rebound as buyers start to emerge and come back into the market. Just recently, we put an industrial property on the market. We had 4 offers on the building. So there is an active buyer pool in the market. So how does this compare to 2008 to 2010? Well, it's different, okay? In that market, the flex market declined from peak to trough by 57% in value. So what that means is if you sold your flex building at the bottom of the market compared to where you could have sold at the top, there was an average price per square foot correction of 57%. That market recovered by 2012. The retail market declined by 31%. It took until 2016 for the average price per square foot for retail to recover. Industrial declined by 32%, had recovered by 2014, and office declined by 47%, bounced back pretty quickly, similar to Flex in 2012. This is a chart just showing you the peak and trough activity in that market during the 2008 to 2010 period. I don't think we're going to see the same pattern repeat here this time. And the reason why I say that is because the market's bifurcating. We're seeing a fragmentation occur. When the market corrected in 2008 to 2010, all asset classes were affected. What we're seeing in this market is a separation of office and industrial from flex and retail property. And so what we're anticipating seeing is different pockets of the market having positive stories and different pockets having negative stories, and then banks coming in and then figuring out where they want to lend and where they want to be active. So it's still coming together, but I wanted to get this information out to you now so that you can see what's happening. The data tells its own story. If you want to talk about individual transaction activity, we're talking to sellers and buyers every day, lenders every day, and we're getting a lot of real-time information. Happy to share that with you. You can request a consultation via our website at mansardcre.com. You can schedule a 30-minute call with me, Jeremy. I'll be happy to sit down, hear about your situation, what your questions are, learn everything I can about what you'd like to accomplish, and then I can help come up with an assessment and some recommendations on a go-forward plan. So again, this is Jeremy Serrier with MANSARD. Happy to bring this information to you. And if you are interested in learning more about what we're doing and opportunities we're bringing to the market, please subscribe to our channel here on YouTube. When we post new video updates, you'll get a notification. Just make sure that you click that notification bell, okay? So happy to meet with you today to give you this information, and look forward to speaking with you soon. Take care.